Hi there, I'm Liz Jarvis. You've landed at the heart of the financial rebellion. I'm here to walk you through reframe number 6 from my book, Financial Rebellion. It's around pages 85 to 91. And although the important part of this is the slideshow that shows step by step the way the heart builds up, for context, I'm going to read the whole section. So, reframe number 6. The story is formed by the heart of your business. This reframe shows how that story is built into two elegantly simple reports. They are usually referred to as the profit and loss statement and the balance sheet. Call me crazy, but I love accounting. I had forgotten how magical it really is until I was fully immersed in an intensive book writing retreat trying to work out how to help business owners like you. As I wrote this book, I fell in love with accounting all over again. To be honest, it's fascinated me since I discovered it was the information factory inside every business. I love how the numbers intersect with humanity to help us improve our businesses. Accounting magic takes the money you make and spend, transactions, and turns them into stories about your business. It's actually quite powerful what can be achieved or manipulated with business numbers. And it's also dangerous. Like all power, it can be used for good or bad. Things like KPIs, key performance indicators, can shape the behaviours of your workers, sometimes in unintended ways. I like the way the entourage used the 6 pillars of business: marketing, sales, product, operations, finance, and people, to help business owners better understand the different areas of their business. Now, there's tons of education on most of these, but there is very little on the financial pillar. So I was really chuffed with myself when I realised that the financial pillar is really about getting information from all the transactions generated by the other pillars and bringing them together into a simple summary. If we think of it as a pump moving information from one place to another, it's less daunting. In fact, I like to think of that pump as the heart of the business, looking after all the transactional information and pushing it to where it needs to be. You see, only last century, many business owners kept their own ledger books in their own handwriting with their own notations. Those records were easily accessible and familiar. Or perhaps they just wrote details on their check butts and someone else processed it. Today, computers help take the work out of calculations and repetitive tasks, but they have no humanity. We are rapidly getting to a place where the younger generation often assumes the computer knows best, but we are rapidly losing sight of what goes on behind the screens. We also are losing touch with who is responsible for what goes on in there. Someone or something, often AI, is calling the shots. But it's your business and you should be calling the shots, deciding what goes where so it's meaningful to you at the end of the day. Let me lift the veil for you to show how those financial statements, your balance sheet and your profit and loss statement, come into being through my heart of the business diagrams. I have simplified those 2 reports here to ultimately illustrate the movement of data. So we have our profit and loss statement on the left. It reports income and expenses during a relevant period, and it uses that information to calculate profit or loss over a period of time. You will often see the heading on a profit and loss statement saying period ending perhaps period ending 30th of June 2024 we're in right now, or perhaps the month ending or the period ending 31 December or 31 January. The point is, it's a period ending. It might be a month, it might be a year, and in fact, the accounting systems today could probably do it for you over 2 or 3 years if you've got the data there. On the right is the balance sheet. So on the right of this diagram here is our balance sheet. It reports assets, liabilities, and equity. It's at a point in time, and when you see the reports, they are often headed up as at 30th of June, 31 December, always as at, not a range of dates, a single date. And that is a very important difference between the profit and loss statement, which is for a period of time, and the balance sheet, which is as at a point in time. Now let's imagine for a moment that your business hasn't started yet. In that case, both reports would be empty with no numbers to show, just like they are on the screen right now. Now I want you to think about the mechanics of a business. Money changes hands for everything you do in business. That exchange creates entries in your accounting system. Much of the time, before that money changes hands, an invoice is issued, which needs to be paid, and also creates an entry to follow up. In the exercise ahead, we're going to ignore the GST in Australia or other value-added taxes from other countries. The elegant simplicity of these two reports is achieved by all those entries through moving through what is known as a double entry bookkeeping system. It's not really rocket science, and I'm sure you can follow along with me by looking at these diagrams. Before we launch into this detail, please be reassured that if the only thing you get from this segment is that your financial statements are a report that summarizes what's going on in your business, then that is a huge step. I don't want you to think that this is going to answer every question you have about accounting, but I really encourage you to breathe deeply and lean in and think of this as a story, not as accounting, not as numbers, not as any of those other things, but just a story about how the financial statements work. So we're going to move on now to illustrate the most important transactions that populate these financial statements. And in the book, I couldn't show every slide. We just showed the beginning and the fully populated story. But here I'm able to show you through the slides. So we start with our empty one. And off we go. All right. The first step, if you're in business to sell stuff, right? You're in business to sell goods or services, but I'm going to illustrate it as if you sell goods, because even services have cost of sales. All right, we start at A. You sell stuff. That shows up as sales, as income. Some people call it revenue. There's all sorts of labels that can be here. So it turns up as sales on your profit and loss statement, and it turns up as receivables on your balance sheet. I even have the debits and credits here for anyone who wants to look that closely, because the debits and credits do a lot of people's head in, and it takes a while to get used to them, and even us accountants get them wrong sometimes. So I will speak to them, and traditionally we speak of debits first and credits second. So when you sell stuff, a debit happens in your receivables and a credit happens in your income. At the same time, there would be inventory or cost of sales happening. So at B, we show that there's a cost of sale in your P&L, So your income's reduced by the cost of sale. And there is inventory declining in your balance sheet. So stock moved out of your balance sheet. Again, speaking of the debits and credits, we have a debit to cost of sales and a credit to inventory. The next thing that happens is that your customer pays you. When your customer pays you, it just changes your balance sheet. Your receivables decrease and your bank shows the money that you got. So it's a debit to our bank and a credit to our receivables. So that's pretty simple. What else is happening in our business? Well, maybe we need to get some more inventory. And again, it might be billed to us and we're not paying it yet. This is an important part. Even if you are paying cash all the time for things, the way that your accounting systems work kind of assumes that you get the bill first and then you pay for it later. So working at number D, if you're following along in the book, it's only your balance sheet that's affected with an increase in your inventory and an increase in your payables. And if we're doing the debits and credits, it's a debit to inventory and a credit to payables. So the next thing you might do is you buy other goods and services. All of the other costs incurred in running your business being charged to you by your various suppliers. Naturally, they're going to affect a variety of expense lines. And I don't think you can see my mouse as I do this, but we've just got expenses as one thing. So they affect the expenses and they also affect your payables. Again, we've got a debit to expenses and a credit to payables. Hopefully you're following along okay. We've color-coded it so you can follow. A's got green lines, B's got the dotted purpley coloured lines, and so on and so forth. So you've bought some extra goods and services, you have some payables for that. Logically, next, you pay the bills. Perhaps that happens at the end of the month. Certainly in the old days, they were quite routine things that happened at the end of the month. These days, there is an expectation of cash on delivery or upfront payment, so it might be instantaneous. You get the bill and then you pay it. And when that happens, your bank goes down. That's a credit to your bank. And your payables goes down too. So we don't owe someone anymore. We have taken the money from our bank and paid it to them. So what else goes on in our business? Well, chances are we've got some wages. We've probably got people in our business. Wages are often processed before the actual payment. Particularly in Australia with single touch payroll, you're somewhat forced into doing wages with a payroll system. And the system generates some transactions for that. So at G, we are processing the payroll. Wages expense happens and a wages payable and possibly a superannuation payable as well is generated. And even the pay-as-you-go withholding tax that you have taken out of the wages from your employees to set aside for the tax office, that happens. So to summarise that transaction, we've got a debit to wages and a credit to a variety of payables, being wages payable, super payable, and PAYG payable. All these things are labelled differently in every software and by different people. We'll come to that later because I encourage you to understand those words or change them to words you understand. But for now, we're just focusing on the fact that you process your payroll. That brings a debit to wages and a credit to a bunch of payables. Just something to be aware of here that I point out in the book is common mix-ups can happen here. I see it very often when there's a misunderstanding about this. When it's time to apply the bank feed, often people will see the wages amount they've paid to their employee and assume that that goes to the wages expense. Hopefully I've been able to illustrate to you here that the wages expense is created when the payroll is processed, not when you account for the money coming out of the bank. All right, so moving on, there's still more things happening in our business. We've got a few more labels here. I want to go back to it. Yes, you pay that payroll. When you pay that payroll and the money comes out of the bank, it also reduces the payables. When you pay the tax and the super, a similar thing happens. So we've got most of the transactions going on here, and then the next thing to consider is that you've got to calculate your profit. So in calculating your profit, we are taking into account all the things we sold, all the things that we purchased to sell, all the expenses that we paid to our people and the wages that we paid our people. And so then we can calculate our profit. And that is shown at label I. It's just it's a simple calculation. It's not actually any movement of money. Once we know our profit, we should be calculating our tax. Now, admittedly, this generally happens at the end of the year when your accountants do your books, but it's important that you're aware how that is recorded ideally, and that is recorded ideally as tax payable. So we're on the green line here. Tax payable, we're missing something, is the credit, and tax expense is the debit. So these are usually done with these would be done with a journal entry by the accountant. But it's an important part of the picture because we must remember that our profits are taxed and we want to make good profits and pay just the right amount of tax. When it's time to pay the tax, then the money comes out of the bank and reduces the taxes payable. So that was K. There's a couple of other things that happen. Often you've got to put some money into the business to keep it afloat or to get it started. And then at times over the lifetime of the business, you'll also take some money out. Now, let me just read from that properly. So labels L and M show the reality of putting the personal money into the business and hopefully taking money out for personal use. I note that this could take the form of dividends, but we're not going to go into the complexity of that here. I've covered it in other parts of the book. So hopefully this slideshow has explained neatly and tidily how your financial statements come into being. And while I've got your attention, I'd like to give you a word on record keeping. Record keeping is a business essential. Why? Spoiler alert, it's not because the taxman says so. You keep your records so that you can see where you are, where you've been, and more importantly, where you're going. It's kind of obvious, and yet we often don't want to know. The anxiety we spoke of earlier in the book keeps us away from looking at our business and our business records, our financials, because we are scared that we were wrong in some of our decisions. We're scared that we rely on the drive inside us to continue our business and striving, and so decide to deal with the truth later. Another truth is that every business is different. I encourage you to look at your financial statements and be aware of your business story being told by that pumping heart. The thing is, some businesses are profitable from day one. Maybe they're copying someone else's proven practices. Some businesses take a big chunk of capital to set up. Some businesses started accidentally and others still from necessity. But all our businesses have one thing in common: transactions. Heaps of transactions swirling through our emails, our apps, and our bank accounts. Record keeping is about capturing those transactions with a butterfly net, if you like, and gently but certainly placing them where they live. Where they live? What you say? I know. I am repeating previous discussions in different ways, but this is the most important concept that you must grasp. Let me challenge you to find a very special home for every transaction in your business. What? I hear you say, why me? Why is it my job to find it? Find the home for it. It's not the bookkeeper's job or accountant's job to decide where things live. Actually, it's their job to get those transactions to where you want them. This thing is telling your story, the story of your business. I'm sorry to make you squirm as you think, but I don't know where the numbers go. I don't even get the numbers. So please bear with me as I try to connect the dots for you in a way that no professional accountant before me has done. It took me years to stop looking at businesses with an accountant's brain. I needed to do that, though, to work out how to resolve the damage that's been done by these oversimplified accounts in the last 20 years. And along that journey, I started to see more and more incorrect financial statements, more and more anxiety-filled business owners, more and more lost souls with brilliant business ideas. I also got to mentor many amazing business owners, some for a free single session, some for many years. They went from strength to strength as they embraced the reality that the financial power was in them. But I digress a little. There's much more in the book. Back to the point, why should you find a special home for every transaction in your business? The home I speak of is just words that describe the numbers that appear next to them. Those words and numbers will appear in the elegant summary of your business that is called the profit and loss statement and the balance sheet. The words can be as many and varied as there are businesses. They can be in any language. Traditionally, the business owner and or their trusted advisor would have defined them for the business. In Mesopotamia, they'd have been recorded on clay tablets. Later, they'd have been headings in a handwritten cash book. For expediency, an accountant may have summarized many columns into a single phrase to minimize typing and make annual financial statements short and concise. When I think of farming, just an addition here, when I think of farming, the standard chart of accounts often puts seed fodder and fertilizer together. Well, if you know anything about farming, they don't really go together. They're seasonally different. And so if you're lumping them in one spot, like, the standard chart of accounts have them today, it's not going to be helpful for your business. So this is why it's important to make your own decisions about where you want things recorded and give that clarity to the people who do bookkeeping for you and own your financial power. So, has the concept of the pumping heart of your business helped you to see the importance of your record keeping? Your business is writing history, my friend, helping you to remember why you spent what you spent and showing you how to get further and further ahead. Hope you've enjoyed this presentation. It took a lot longer than I thought it would, but it's been my pleasure to read from my book and to show you through the pumping heart of your business. And I hope that you will never see a P&L and balance sheet the same way as you did before, because likely they scared the whatever out of you and you felt you couldn't understand them. But when you see them as the story of your business, when you understand that they've been built up through all these transactions that you do, you actually make the decisions about what's going to be spent, about what you're going to sell people. Why shouldn't you make the decisions about how your story is told? I'm Liz Jarvis. I'm the author of Financial Rebellion. I have a business called Better Business Decisions where I mentor business owners. I hope this has been helpful for you, and I look forward to hearing from you in many other areas. Please share this video. Wouldn't it be awesome if it went viral and the millions of business owners that I want to help got to discover that accounting is not maths, it's storytelling, and every business owner has the power to tell that story their way. Have an awesome day. I hope to come across you again sometime soon.